In our business, in the fund business, the norm is you raise a fund, you can't raise the next fund until that fund's normally 80% invested. So we raised Fund 2, but we put in there language. We asked for the ability that if, while we were investing Fund 2, if great opportunities come along, we should be able to raise Fund 2B, even if 2 hasn't invested yet. And I don't remember where we got the nerve to ask. And I don't remember why anybody said yes, but they did.
It was actually 400 in total, 2B. Are you? Oh, okay, sorry. I gave away the punchline. I'm sorry.
But if you...
When he hired me, this was in '87. I wrote the business plan. I thought it was very sound at the time, but then we had to go out and raise money,
Yeah.
which people had no idea what distressed securities were. This was all falling on your shoulders. What went through your mind? And how, what was your pitch, and how did you educate these institutions when you started talking about buying, you're going to buy companies that are going into bankruptcy? Yeah. They would look at us really funny. Yeah.
Among X people you talk to, if you say, you should do this because nobody else will, some people get it. Maybe most don't get it. But some people understand the benefits of contrarianism. And that was a big appeal. As Bruce says, fortunately, we'd been able to build up a reputation at that point in time, both for good performance and for trustworthiness, which I think played a big part in it. And, you know, the TCW imprimatur probably helped as well. So we scraped together $65 million on our first closing, and that was October the 28th of '88. And Cambridge is a consulting firm that is the leading consulting firm for foundations and endowments, and they put us on their list. And we got a lot of names from that.
Howard raised almost all the money. I was happy because Eli came in personally and with his insurance company, Sun America. So that helped give me a little credibility that a fairly well-respected investor like Eli Broad would be willing to endorse this. But basically, it was Howard put that whole thing on his shoulders and got us to $96 million, which doesn't sound like a lot at this point. But back then, we were instantly, probably the second largest fund. There was one other that raised a little more than us, and certainly one of the top 3 investors in the burgeoning field of distressed securities.
One of the interesting things to note as a side note is that other fund, which was $104 million, as I recall, to our 96, that was the only fund they ever raised. So it's not enough to raise it once. You have to have staying power.
Well, when I got into it and really tried to apply the business plan that I had written to the environment, I found that I didn't love the risk reward involved with buying subordinated bonds because they hadn't dropped sufficiently enough in price to feel like it gave me the margin of safety that was necessary.
If you think about a balance sheet, a capital structure, like a tree, it dies from the bottom. So if there's a financial problem, first the equity loses its money, and then among the creditors, the subordinated bonds are in the first loss position. And one of the important things in investing is to invest within yourself. Like they say, in football, you should play within yourself. You should play within your capabilities. You must have a plan of operation, which is simpatico. I don't know if you use that word anymore. With your personality. If you're an aggressive guy, you just can't play it safe. If you're a chicken, you just can't play it risky. And we're both conservative investors. And I think Bruce, when he found the idea of the ideal basic trade, liked the fact that the bank loan is basically in the last loss position. So everybody else has to lose all their money, pretty much, before you start losing. And so obviously you take less risk. In theory, you are due a lower return, but in truth, I think in our experience, that conservative position enables you to do it more strongly.
Yeah, and that first fund, Howard, you'll recall that there was an energy collapse in the late 80s. And so what did we do in the first fund? Sort of waiting for the environment to come our way was basically play around in the oil patch, drilling rigs, buying debt secured by drilling rigs. And then in late 89, early 90, we could tell that something was going on in the economy. And this is when I turned to Howard and I said, boy, it would be great to have a lot of money right now.
Yeah.
Now, a lot of money back then was like a couple $100 million. But again, I put the horse on Howard's back and I said, can you raise us a lot of money? Because I think there could be a great opportunity here, particularly if defaults in the high yield bond market pick up.
Well, and in fact, the LBOs that Bruce described as having taken place in the LBO boom of 85 to 90 were generally financed with 95 or 96% debt.
Yeah.
So there was just a tiny cushion of equity at the bottom, and once you got through that in terms of diminution of value, you would start having defaults quickly. So we went out to raise Fund 2, and we raised, as I recall, $280 million, which was a lot. I don't know how we did that, frankly. But I have no recollection. But the and
it
then
wasn't me.
But then if you look even further, what I really can't.
It was
remember,
actually 400 in total. 2B. Are you? Oh, okay, sorry. I gave away the punchline. I'm sorry.
But what I really can't remember, if you look back, and maybe you can, is in our business, in the fund business, the norm, private equity, venture capital, what have you, the norm is you raise a fund. You can't raise the next fund until that fund's normally 80% invested. So we raised Fund 2, but we put in there language. We asked for the ability that while we were investing Fund 2, if great opportunities come along, we should be able to raise Fund 2B, even if 2 hasn't invested yet. And I don't remember where we got the nerve to ask, and I don't remember why anybody said yes. But they did.
Well, I do. Let me tell you why. This could have been the very, very first Howard Marks memo. Because he wrote it, he's a brilliant writer, as you know. But even back then, he was a brilliant writer. And you crafted a memo, probably on one page, because you like to get everything on one page, and laid out the case for why investors should give us money in this B tranche. Yeah. And it was brilliant, and we found some takers. Yeah. And
so we raised two, as I recall it. Memories are not perfect, but as I recall, we raised $280 for Fund 2, and $240 for Fund 2B. So we raised Fund 2 in July of '90, and then in the fall we said yes, there's going to be more defaults, and defaults were starting to happen. So we raised $240 for Fund 2B in December of '90.
And I put that money to work very quickly.
Yeah.
The markets in '90 and '91 we were in a very deep recession was unfolding, which, by the way, was accompanied by S&L failures and terrible
Gulf War,
depression, very serious recession in the real estate industry.
And the government mounted a jihad against high yield bonds. Drexel Burnham, Michael Milken went to jail. Yeah, and when they took out the leading investment bank for high yield bonds, meant there was nobody around to do exchange offers, and
default rates in the high yield bond market spiked to double digits 2 years in a row. It was really a great time to be a distressed investor. And by the way, we had much more money than virtually anybody else. I think that period really put us on the map. And we did a nice job putting that money to work. Now all of a sudden, Howard, it's not so hard to raise the money, but we made an interesting business decision
for Fund 4.
For Fund 4. And I think it's worth kind of talking about what went through our mind, and it really dovetails with your notion of cycles.
Yeah. So for Fund 4, we went to people and we said, for every dollar that you had in 3 and 3B, you can put in 50 cents in 4. And Fund 4 was $386 million.
It could have been 4 times that, easily.
And there were not many opportunities for Fund 4. Having a smaller fund permitted us to take advantage of the ones that were there. The key is, there's a great temptation. If you have a great fund, you make the next one bigger. because the bigger the fund, the more your fees, the more your potential carried interest. Bruce's funds 2B, 3B put us on the map, but I think that action in 4 created our reputation.
He really did. And I think from a business perspective, that was a huge thing.